Let's bring in our market panel, Jim Paulsen of Paulsen Perspectives and Timi Urbanowicz of Innovator Capital Management. Good afternoon to you both. Jim, I will start with you. What to make of this jobs report? Because it does seem like there was something for everyone, depending on which part of it you dug into the most deeply.
You know, Morgan, I swear most payroll Fridays are just like that. They've got, differential information, and you start it really on Wednesday with the ADP report, the Thursday claim numbers. Friday, you got the payroll, you got the household, you got all this residual statistics. And today's a great example of what I think is just confusion. I think at the end of the day, you got a bigger 272,000 gain in payroll, but a big 400,000 plus loss in household. You had a loss in full-time jobs, an uptick in unemployment, little uptick in wages. I think what it says, there's, like you said, on both sides, I think it says the economy is in okay shape. I don't think it's headed for recession, and I don't think it's overheating either. I think that's the message of today's report.
Okay. Tim, what did you take away from the report, especially as we did see, as we mentioned, yields higher today, and despite a recovery in the worst of the losses for the major averages, the Russell still finishing down 1%, down 2% on the week?
Well, Morgan, I don't think it's the report that the Fed wanted to see necessarily. You had multiple things going on there. You had job creation that was very strong. You had wage growth that was above expectations. That is significant. For us, it really reinforces the view that we have held all year long, which is that you are not going to see the Fed cutting interest rates this year. We're going to have to be in this environment where interest rates are higher for longer. But I do think the good news here, Morgan, is that this is still an environment where equities can do very well in. You back up and you look at the index, everybody talks about the concentration that we're seeing in the Magnificent Seven and the risk that presents, and that is true. But we also have to remember that this is a subset of stocks that has done very well in the face of rising interest rates. Since the Fed began its hike cycle back in 2022, the Mag 7 is up over 75%. So this might not be the report that the Fed wanted, might not be a good report for the average American, but it's still an environment where equities can thrive and continue to do well.
Yeah, I'm glad you brought that up. I mean, Jim, the top heaviness of the market right now, is that what still continues to work from here on out, or do you take this opportunity to diversify, and if so, into what?
I differ a little bit, Tim. I agree that I think the equity outlook remains good. I think we're going to have some pretty good upside move yet this year, Brent. But I also think it's for a little different reason. I still think the economy is slowing down. You got the Citigroup Economic Surprise Index now below zero for all month. One of its biggest declines, negative since early 2023. A lot of data is coming in on the weaker side. I think there's interest rates look out of bounds on the high side to me. I mean, when the 10-year Treasury was 3%, when inflation peaked in June of 2022, over 9%. The inflation rate came from 9 to 3.5. Now wages went from 6 to 4. Commodity prices fell by 30%. Oil went from $115 to $77. Here, the 10-year Treasury went from 3 to 5% and is still 4.4% tonight. I think they're way out of bounds, and it won't take much, I don't think, to convince the Fed that they have to ease. And if they do, we bring down the 10-year and mortgage rates. I think we lift confidence, and I think this market broadens out. Finally, we include small caps. We include defensive stocks. We include even international stocks that have been lagging. And so I think we have a broader market rally into the end of this year. I don't think that Mag 7 is going to collapse. I just think they're going to underperform from here. It's going to finally get a broad breadth market going in the last half this year.
Well, speaking of the Fed, speaking of Mag 7, I mean, Tim, we got a stock split for NVIDIA that takes place here now after the close. We'll see that start to play out in the market next week. We've got the Apple Developer Conference on Monday. A lot of expectations going into that one. We get more inflation data with CPI and PPI. And then, of course, a Fed decision where largely expected we're not going to get a cut, but the dot plots are going to be very telling.
Yeah, that's absolutely right, Morgan. And I think what's so critical right now for investors and in their portfolios is you have to separate the reliance on interest rates coming down and playing defense in your portfolio. For the foreseeable future, whether it be up or down, interest rates are going to remain the key driver of equity prices moving forward. So that means, breaking that link with bonds, not relying on bonds for risk management, and also just shying away from a lot of those interest rate sensitive sectors like utilities at this point. You just can't count on them with yields being the number one driver. So we continue to like leaning into what has worked thus far this year and shying away from the interest rate sensitive sectors and bonds for risk management.